Well, the Bank of Canada today, July 12th, 2022, raised its rate a full percent, exceeding the expectation of most economists. This brings the prime rate to 0.75% above where that rate was pre-COVID. This larger than expected JOLT is designed to nip inflation in the bud. But will it work? Inflation is persisting more than the bank's policymakers forecast. Surveys indicate that more consumers and businesses are expecting inflation to be higher for longer, raising the risk that elevated inflation becomes entrenched in price and wage setting. This may mean that we will see some wage increases to close the inflation gap as the change of higher prices becomes more entrenched. Now, with lower levels of unemployment, we are already seeing upward pressure on wages, particularly for new hires in certain industries. Inflation is expected to continue to hover around the 8% mark for the coming months, but it should lower toward 3% by the end of the year and be landing somewhere near the 2% target late in 2023. So as long as we see the month-over-month inflation calm down, once we're a year into it, then the year-over-year inflation will be much closer to on target. Global inflation, of course, is also elevated, indicating that this isn't really a made-in-Canada problem. So for now, the Bank of Canada decided to front-load the path to higher interest rates. This wording suggests that while future rate increases are clearly on the table, we can expect them to be smaller increases. The total expected increase after today's announcement is 0.5% to 1% higher by the end of the year. So what does this mean to you? Well, if you're looking to qualify for a mortgage now, it does mean that for the first time in all of the increases so far this year, the amount that you're going to qualify to borrow is now reduced a bit. This is because of the mortgage stress test requirement. We have to use a rate that's at least 2% above your rate or 5.25%, whichever's greater or higher. So now that new variable rate mortgages are going to be coming in at about 3.8%, we have to run the stress test at 5.8% starting today. So if you were fortunate enough to get a fixed rate in 2021 or earlier, nothing really changes for your mortgage until the end of your term. If you already have a variable rate mortgage, like most borrowers have chosen in the last 6 months, and like I did personally just this past month, a 1% increase to the rate means about a $50 a month increase for every $100,000 that you borrow. A further 1% increase over the rest of the year will, of course, still leave you with a lower payment and a lower interest rate than most new 5-year fixed rate mortgages available today. That said, if a 5-year fixed rate is really what you want, we do have a couple of options right now at 4.5% that we can look at if you're interested. Other lenders are all at or above really 5%. So what does the future look like? Well, the Bank of Canada Governor Tiff Macklem and his team estimate that the neutral rate, which is a theoretical setting at which their rate neither helps nor hinders economic growth, is between 2 and 3%. Now, that's the bank's rate, not the actual prime rate, and we're right in the middle of that now. However, they have made it clear that they're not finished raising rates. They say that they will likely have to push the benchmark rate above 3% to get inflation under control, but it's not going to be permanent. Most economists are expecting that once the rate settles, it'll stick around for about a year. And if we see some recession pressures, that may change and it may be even shorter. Only time will tell. Now, last week, RBC predicted a moderate recession in 2023 with increased unemployment as a result of higher interest rates. In June, Bank of Canada's Governor Tiff Macklem told reporters that the economy can handle and indeed needs higher interest rates, stating that its goal is for a soft economic landing with inflation coming back to about 2%. So my main takeaway with all of this is that while rates are elevated and we are seeing downward pressure on real estate pricing, now just might be the time to get yourself into the market as long as you can handle some payment fluctuation before the rates start to drop, probably in a year or two. It's always easier to get a great deal on a home if you're not competing with other buyers, and a little bit higher interest rate for a couple of years will end up costing you far less than what a bidding war on a house is going to cost you. So, as always, my team is here and ready to help. Please use the link below or the form below this video to reach out to us, and we can customize our advice to your specific situation.